We're going to take a look at some big names, especially Micron and CarMax, in today's earnings exchange. Jeff Kilburg joins me now. He's KKM Financial's founder and CEO. Jeff, welcome to you. Let's dig right in with Micron. This stock is such a bellwether, I think, in many ways. It's up over 30% this year, in part because of AI hype. But we're also expecting to see the first impacts of China's ban on Micron sales to some key industries. So the company thinks around a low teens % of revenue. Stifel thinks supply cuts generally should help with their pricing power. What do you do with the stock here?
Well, Kelly, I want to be a buyer, but you're absolutely right. You're seeing expectations for a loss of $1.18. That's in stark contrast to the $1.45 they earned just a year ago. And they've been grappling with a lot. They've been trying to figure out supply. But in the recent months, you have seen a rebound in memory chips. And that has really helped outperform or catch some of that performance up about 35% year to date. It's interesting, though, when you talk about Micron and what they're doing, the decisive actions to try and bring back that supply and demand into balance, I think they really have an opportunity with Intel as well being banned in China to really go through this. But I think if you're a buyer here, it's going to make sense. I know we're kind of coming off the artificial intelligence euphoria, but at the end of the day, this is a semiconductor name. We are going to see memory chips come back. Everything we utilize, Kelly, wants more and more memory. I talk to my kids all the time. They want more and more games with more and more memory and more graphics. So at the end of the day, I want to be a buy here on Micron, despite the fact it's been a rough year after a really challenging 2022.
It's still hanging in there so far year to date. Let's move on then. A totally different one, CarMax, though, and there's an angle here to the UAW strike.
Shifting gears, I think you could go with, Kelly.
Thank you. But no one does that anymore. Pressing a button to shift gears. How about that? The market for used cars has softened, but Wedbush is saying the UAW strike and tight supplies could drive used car prices back up, although CarMax, Wedbush says, has also been lagging competitors. So what do you do with this one into earnings?
You know what? I want to be a buyer here as well. It's hard to say, in the month of September, you want to buy here. But if you look at $73, that lines up well. The technical's a 200-day moving average. So you can either be a buyer, be very patient here after the earnings, or you could sell puts at that 73 strike price. But at the end of the day, you've seen a parabolic move in interest rates. To beat a dead horse. We all know what happened in 2022, and that really stung the consumer. So when you see 2022, what happened to CarMax down over 50%, yes, it has gone down more than its competitor. Look at cars.com, which is about 10 times smaller than CarMax. But I think you own this a little bit lower. I think it makes sense here, especially, this is something that, it should have significant support. So if you're a buyer here at $73, Kelly, I think you look at $70 and put a lot of price volume in there, and I feel comfortable owning that name because we will see the continued recovery in used cars market.
All right, I want to pick up, Jeff, on something you said there and kind of pivot you to the broader markets, if I may. Today has gotten really interesting, for lack of a better word, and it's not that we're seeing fear and panic. The VIX is pretty stable, things like that, but you have oil at 93, the dollar at 10-month highs, bond. I mean, the 10-year was at 462 last check. Someone check on the 20-year; it's probably almost kissing 5%. And stocks are not reacting well to all of this.
No, it's not. And I think this is in the context, where have we come from? We've come from a surprisingly good year to date. So September, you're seeing a lot of rebalancing. You're seeing portfolios potentially take profit, go into different sectors. You look at small caps. You look at some of these names that have really been impacted by the interest rates. No one thought that the 10-year note was going to go above 4.5%. I don't know if that's sustainable, but with all the rhetoric coming out of the Federal Reserve, yes, people want to see how high these yields will go before they relent. But I think this is an opportunity when you see the interest rates, which of course the bond leadership. It's been bond leadership ever since we've seen COVID come about. But I think there's an opportunity to really sift through and pick some great stocks that are going to have interest rate sensitivity. But I am in the camp, Kelly, that we're going to see the interest rate, specifically the 10-year note, hit 4% before it hits 5%. I know that's a lonely view.
It is, but I'm encouraged that someone still holds it because, sentiment has kind of gone so far to the other side with us asking is 5% next, is 7% next, and you name it. What do you think the bigger pain point is right now? I mean, do you think that people are kind of too bearish on treasuries now?
I think a lot of new bond experts, we get a new one anointed daily, it seems like. But at the end of the day, I think people are trying to understand with all the cash on the sideline. Cash really found its home last year when you saw the yields pop up to 5%. I think now this is, again, a counterintuitive view, but I think people are trying to reposition into some of these stocks that they are finding value in. A lot of growth stocks are finding value. Specifically, I go back to small caps. I talk about some of the names that we don't really think about, the Lockheed Martins, the 3M. Some of these names have really been impacted, and also the interest rate sensitive names. So that's where we're at moving forward.
All right. Jeff, thanks for your time. We appreciate it.